Welcome back to the Deep Dive. If you're in the AI space, or 3D art, or even just watching the infrastructure race, computational power is basically the new oil. Today, we are really digging into the asset built to try and solve that GPU energy crisis, the render token, RNDR.
And we have a seriously dense stack of sources today. I mean, it goes from the super technical white papers about network architecture,
right,
all the way to, the algorithmic strategies that professional traders are using to navigate its pretty intense volatility.
Our mission here is crucial, I think. We have to move past the hype and really get at the utility. How does RNDR actually solve this huge computational bottleneck that's strangling, global AI and high-end digital content?
And can it even work? I mean, can this decentralized GPU network really scale enough to compete with the huge centralized cloud monopolies?
That's the real question, isn't it?
That's the core tension of this whole thing, because the demand for compute, the kind of compute only these high-end GPUs can do is just growing exponentially. But the supply is so concentrated and so expensive, it's a real crisis.
Okay, so let's start with the scale of this problem, this computational bottleneck. We're talking about large AI models, think GPT-3, or these next-gen media experiences like AR and VR.
Yeah, complex stuff.
They demand resources that the centralized providers, they either can't or just won't supply affordably.
And the sources really drive this home with some staggering numbers. Think about training a model like Stability AI.
Yeah.
You're looking at needing 4,000 GPUs. That translates to millions of dollars.
Millions.
Just in compute time. And that's before you even think about building your own infrastructure. The raw hardware cost is it's brutal.
And the sources note, an enterprise-grade GPU, something like an NVIDIA A100.
A top-of-the-line one.
It retails for anywhere between $30,000 and, $52,000?
Per unit.
Per unit. That level of spending just pushes all the cutting-edge development straight into the hands of the tech giants. They're the only ones who can afford to stockpile these things.
Exactly. It creates this classic high-stakes Sophie's choice for, smaller studios or independent AI researchers.
Right.
You either pay these massively inflated cloud prices, or you just can't compete. You can't even play in the arena. And so innovation, it just becomes a gated community.
So this is where Render Network steps in, positioned as the decentralized solution. It's a peer-to-peer GPU compute platform. And the elegance of it is that it doesn't try to build new data centers. It just tacks into dormant GPU power that's already out there all over the world.
It's just a totally different way of thinking about resource utilization. They're leveraging everything from, an artist GPU that's sitting idle half the day
between jobs
to unused mining rigs. It just creates this open, democratized marketplace. And the scale is growing fast. Based on the numbers from early 2024, we're talking about 5,600 node operators managing over 50,000 GPUs globally.
That's a massive geographically distributed computer, essentially. And while RNDR started with visual effects and 3D rendering, the pivot towards generative AI, that's what makes it such compelling infrastructure today.
And that's why it falls right into that DePIN sector decentralized physical infrastructure networks. The whole market cap for these decentralized AI compute tokens grew by an insane 507% in the year leading up to March 2024.
100%.
These networks are just inherently more resilient. They're potentially way more cost efficient, and they serve this broader goal of, decentralizing control over the very infrastructure that's going to power the future of AI.
So if the big guys are selling compute based on what they can supply from their data centers,
right,
RNDR is leveraging what's already sitting there unused. It's a fundamentally different and, like you said, potentially much cheaper business model.
Okay, so to run a global resource pool that complex, you need a ledger that's secure, transparent, and maybe most importantly, fast.
And that's where the blockchain comes in.
Exactly. And while RNDR started on Ethereum, the community actually voted through RNP 002 to migrate the whole core platform over to Solana in 2023.
Okay, why the move? Moving a network that big is a huge deal.
It really is. It came down to speed and cost. The very nature of rendering or AI computation, it involves millions of tiny little microtransactions.
So payments for verification.
For quality checks, all of it. Ethereum, it's secure, but it can get bogged down with high gas fees and slower speeds. Solana just offers the kind of transaction throughput you need to make the platform actually work for high-frequency, low-cost jobs.
That makes sense. Okay, let's get under the hood to what I think is the genius part,
Yeah.
the tokenomics.
Yeah.
Specifically, this burn and mint equilibrium, the BME mechanism. For a utility token that's competing directly with services priced in dollars, this seems absolutely vital.
It is. It's the defining feature. The BME model's whole goal is to maintain consistently priced services. So a creator, they get a quote in fiat, let's say $100 for a job,
Yeah.
but they pay the equivalent amount in RNDR tokens at that moment. This totally shields the user, the creator, from the day-to-day, often brutal volatility of the crypto market.
And that is the key. They're selling a utility, a service, not a speculative asset to the user. So how does the burn part work to keep things stable?
So when that creator pays the fee in RNDR, 95% of that RNDR is instantly programmatically bought from liquidity pools, and then it's burned,
Oh, terrific.
taken out of circulation completely. You can think of it like a controlled furnace. The more the network is used, the more fuel goes in, the more tokens get burned. This counters the inflationary pressure from the other side of the system.
And the last 5%.
That's a network fee that funds the foundation's operations.
Okay, and the mint side, that's how the node operators, the people actually providing their GPUs, get paid.
Correct. They get compensated through emissions, which are newly minted RNDR. They're distributed in regular cycles or epochs, and they're rewarded based on two things. One, the availability of their node.
So just being online and ready.
And two, the successful completion of the job. The network targets a really controlled, low inflation rate, about 1 to 2% a year, and that's all managed by community governance.
That is such a brilliant feedback loop. Usage drives demand, which drives the burn, which helps keep the service costs stable no matter what the wider market is doing. But how do you standardize quality? You've got 50,000 different GPUs all over the world.
That's a great question. They set up a standard benchmark, Octane Bench Points Per Hour, or OBH.
Oh,
This creates a standard unit for performance, and from there, a standard for pricing. And then they layered multi-tier pricing, MTP, on top of that.
and MTP sounds like a really smart way to match the right job with the right hardware. So you have tier 1 for the supercritical fast jobs.
Exactly. Tier 1 is the most expensive. It's the highest priority. These nodes are verified. They're often equipped with those high VRAM GPUs, those $50,000 A100.
And the incentive for the operator is getting paid more.
More pay, a better reputation score, and access to the best jobs.
And then if you're, say, an indie artist and you're really cost conscious, you can drop down to tier 3.
Right. Tier 3 gives you the biggest discount, sometimes 8 to 16 times cheaper than Tier 1. It's going to be slower processing, it uses less advanced GPUs, but it's perfect for background rendering or jobs that aren't on a tight deadline. It's an incredibly efficient market that uses price to allocate those resources.
So speaking of critical jobs, what about security? Big studios, enterprises, they need absolute guarantees about their intellectual property. How does RNDR handle asset security on a decentralized network?
This is where their proprietary tools are really critical. So all the client's assets are hashed and encrypted. They use the open ORBX file format. And the key thing about ORBX is that it decouples the rendering work from the original 3D application.
So the node operator only gets what they need to do the render.
Exactly. They get the data to do the work, but not the entire proprietary source file. It's a huge security feature.
And for digital rights management, or DRM?
Every single rendered frame gets individually watermarked before the client can even download the final output. This verifies payment, and it provides this really deep layer of on-chain provenance and traceability. It makes ownership and usage rights crystal clear.
Okay, we need to shift gears a bit.
Yeah.
From RNDR as infrastructure to RNDR as a tradable asset,
Right.
because it's connected to both high-growth AI and, well, the very volatile crypto sector. Professional traders use some pretty systematic approaches.
Yeah, you have to. The first one of the sources detail is quantitative trading. Quant trading.
Which is all about algorithms.
It's all about math and algorithms to just remove emotional bias from the equation, because RNDR often correlates with broader tech trends or, big AI announcements. These models are just hunting for anomalies or specific momentum shifts to execute these highly disciplined trades.
And then for traders looking at shorter time frames, there's swing trading, which is much more about charting and technical analysis.
Exactly. Swing traders are constantly watching for breakout strategies.
So the price moves through a key level.
Right, when the price smashes through a resistance line or falls below a support line. But in a market this wild, where RNDR's price moves can be so brutal, risk management It's just not optional.
And the sources really hammer this point home.
Yeah.
The stock loss order. Let's connect this safety net directly to RNDR's history.
You absolutely have to use a stop loss.
Yeah.
Let's say you bought RNDR at $10. You might set your stop at $9.50.
Okay.
This means if the price suddenly drops, your position automatically closes. You limit your loss to 5%. This is just non-negotiable, especially when you look at the asset's history.
Yeah.
When RNDR hit its all-time high recently, it was followed by a massive correction, a drop of 71%.
Wow.
If you didn't have a stop loss set then, the damage would have been absolutely catastrophic.
That 71% drop is a terrifying number for any investor. It just perfectly highlights the speculative fever that's wrapped up in this infrastructure play. Let's do a quick snapshot of RNDR's technical health based on the indicators we have.
Okay, we can start with the Relative Strength Index, the RSI. It was recently reported at 28.4.
And anything under 30 is considered oversold.
Right. So this could mean the asset is undervalued in the short term, possibly signaling that a rebound is coming.
A classic bullish sign suggesting buyers might be about to step in. What about momentum?
Momentum is also looking pretty positive. The MESCD, the moving average convergence divergence line, is currently above its signal line. That typically suggests that bullish momentum is building up under the surface.
Interesting.
But at the same time, the longer-term moving averages, the 50-day and the 200-day, they were recently around $4.40, which suggests the price is really just consolidating. It's not in a strong uptrend or downtrend right now.
So let's put that all together. We have this highly volatile asset. It's currently oversold. It's showing signs of bullish momentum, but it's stuck in a consolidation phase. What should a trader be watching for, right now?
Well, the consolidation means it's sitting near a decision point. Traders have to be watching the key support level, which the sources put around $6.72.
Okay, 6.72.
And the key resistance level around $7.17. A decisive break above that resistance would confirm the bullish momentum. But if it falls through that support, it could signal another big move down.
We keep coming back to that 71% drop after its all-time high of 1383.
It's hard not to.
And that volatility, it's not random. It's the market struggling to price a long-term utility that, hasn't fully arrived yet.
Exactly. And that long-term value is tied completely to mass adoption in these key sectors. AI training, virtual production, metaverse infrastructure. RNDR is selling picks and shovels in the AI gold rush.
Right. They're selling the infrastructure itself,
Mm-hmm.
which really sets it apart from a lot of other AI tokens that might just be about models or data sets.
Precisely. And because that utility is so foundational, it's driving this insane divergence in long-term price predictions.
This is really the aha moment that shows you the sheer level of speculation involved here. On the conservative side, some projections have RNDR reaching maybe $16 by 2030.
Which would be, steady growth based on moderate adoption. It's a reasonable take.
But then you look at the highly optimistic analyst forecasts for the same year, 2030.
And it's a different world. The average projections there go up to $110, with peak projections soaring over $130.
Wait, 130? That is a mind-boggling difference from 16.
Yeah.
What has to happen for RNDR to hit a target like 130?
It assumes total critical success. It assumes RNDR becomes the de facto decentralized backbone for global AI compute. It assumes massive institutional adoption and that the BME mechanism successfully manages the token supply even with exponential real-world demand.
That gap between, single-digit returns and potential 10x or 20x returns, that just perfectly illustrates the high-risk, high-reward nature of investing in this whole decentralized infrastructure space. All right, let's try to summarize the key takeaways. RNDR is, at its core, a decentralized infrastructure utility token. It's designed to get around that GPU compute bottleneck.
Mm-hmm.
And its entire economic engine is this innovative burn and mint equilibrium model, which is built to stabilize service costs for users, even while the token itself is, an incredibly volatile asset on the open market.
And the real tension here is about the centralization of compute power.
Yeah.
You have these tech giants basically hoarding all the cards, right? They're creating these choke points in the AI development pipeline.
They are.
RNDR offers this really compelling immediate path towards the democratization of AI. It does it by plugging into it actually using the world's distributed idle computing power.
So the final question for you to really think about as RNDR moves forward is this. The BME model depends on service consumption to fuel the token burn. Given the relentless, just accelerating global demand for AI compute, can RNDR's burn rate, driven by real customer payments, actually keep pace with the minting rate needed to incentivize a huge, high-quality node network?
That balance is everything. It's what will dictate the long-term viability and ultimately whether this thing lands closer to $16 or $130.
Indeed. The token's fate really rests on its ability to prove that its utility can scale faster than the costs of running the whole network.
It's a powerful thought to leave with. Thanks for joining us for this deep dive into RNDR.
We'll see you next time.